Bacon down 5%. Health insurance down 10%. Michelle, you want to unpack this? You guys always have such granularity. I mean, where are we seeing signs of disinflation and where aren't we?
So to me, one of the most interesting things about the CPI report this morning, which Steve touched on, is the food at home grocery inflation finally coming down. And if you look at other indications of what's to come, the PPI report for food last month also showed a pretty meaningful pullback. That's huge. That's really important for consumers that have been facing very high inflation as they walk into the grocery store every week. They're now seeing some relief. So to the extent to which that continues, I do think that's really meaningful for consumer spending, consumer purchasing power, and consumer psychology as well.
Michelle, where are we on the kind of Fed picture here? I mean, so the fact that we're now seeing higher odds even of another quarter-point rate hike is interesting because we have these comments from Mary Daly this morning as well, and she's sounding, I mean, I don't know if she sounds a little more dovish to me. Although she says most likely there won't be a recession, she's talking about how we don't need to hike every meeting now. And again, her district was ground zero for the banking crisis.
So, Kelly, I agree. I thought the comments both from Mary Daly and from Austin Goolsbee were quite similar in that they were talking about the need for patience, the need to be able to, monitor the data, see how things are evolving, look at the high frequency data. I think they're in a point where they are highly data dependent. And to me, the data is not just what they're saying in terms of the monthly jobs report or what they're saying in terms of the monthly inflation numbers. They're trying to be forward looking at high frequency indicators, looking at flows of credit, try and understand what comes next for the economy and making sure that they're not hiking too quickly, not hiking too dramatically, where it's going to create more problems for the economy than do good.
Steve, do you think we're so when you hear these comments from Daly, from Goolsbee, I mean, do they tell you we're setting up for some dissenters, that maybe we're laying the groundwork for a pause? We're less than an hour away from the minutes, but I don't know how much that's going to tell us. That was the first 72 hours after these banks collapsed.
I think there's a potential pause posse that's gathering up. I don't think they're ready yet quite. I don't think they're ready yet quite to say it's time to pause. But what I'm listening for is where the default position is. Now, Daly today said definitively we have more work to do. And yet she went on to offer reasons why the Fed might do more and the Fed might do less. Goolsbee, to me, sounded a bit like he would default if the credit issues become manifest, that he would default on pausing and not doing more. So I don't think we're quite there yet. Like I said, they're gathering up. They're not necessarily together, but there's a foundation being built for the Fed to do this quarter-point hike in May and then to stop. You'll notice that Goldman took away its forecast for a quarter-point hike in June. I think the market is ahead of itself. If you look at that chart that's up now, you can see a quarter point built in by the fall, a cut that is, and another, call it, 50 or so built in by the end of the year. So I think that's too aggressive of where the market is. But in terms of the Fed gathering up to pause, so to speak, I think there is a wing developing, and it's going to, just as Michelle said, depend on the data.
And Michelle, a word, Barkin was kind of talking in your lane earlier this morning on CNBC, saying he watches the day-to-day credit card spending. January was high, February it started to cool, and he says March is flat to even slightly down year on year. So he says we're seeing demand start to cool, not falling off the table just yet. Can you add some more context to that?
Yeah, I mean, I think for March in particular, there are a number of factors to be mindful of when you look at trends in consumer spending. The SNAP benefits expired at the beginning of the month. Tax refunds are coming in a little bit weaker. So there's a lot of factors that we have to be mindful of to understand where the trend is going forward. But to me, if you look at the last, several months for consumer spending, and for us focusing on our spending pulse insights, the consumer is still out there engaging, but they are making greater choices, decisions in how they're shifting their budget. So we have seen a pullback in spending on home furnishings, home improvement, these big ticket items. And we are still seeing acceleration in spending at restaurants. Part of that is inflationary, which we saw in today's CPI report, in addition to lodging and other travel-related spend, which is really holding up very strong. So to me, the consumer trajectory rests very much on the labor market. And at the moment, the labor market is still holding in very, very well.